Let's get an initial reaction on this. We're joined by IG Chief Market Strategist Chris Weston from Melbourne now. Chris, good morning to you. Just firstly on the Westpac, read their bumper record profit up 8%, that cash profit too, better than expected.
Absolutely. I was just very modestly above the expectations on that cash earnings number there, but nevertheless a slight beat there. But I mean, if you look at things like the impairment charge, down 23%, that was slightly better than expected. The net interest margins on the second half came out at 2.06. That was a couple of basis points better than the market was looking for. Perhaps I suppose one negative would be the dividend. The dividend was a couple of cents under, but it was still fairly strong, and it's still a very strong and healthy payout ratio there. Perhaps the analysts are going to point straight away to their levels of return on equity that this company is generating. They saw return on equity boosted up 48 basis points. The market was expecting it to stay flat at 15.9%. So, yeah, that was a significant beat there. So the company is generating good returns from the capital that has been put into the company, and that shows really good efficiencies as a business. And Gail Kelly as well is talking about how optimistic she is for the group, how optimistic she continues to be for housing credit. She reckons that's going to run at the same levels. So I think all in all there was certain elements being priced in. The stock's easily the best performer out of the big four this year. It's trading on a multiple which is fairly lofty. Of course, that doesn't really matter too much. People haven't been trading the banks in terms of their traditional fundamentals. They've been trading them as quasi-bonds, so to speak, and that's not going to go away given what we're seeing at the moment from the macro backdrop. But certainly the numbers today largely in line, if not slightly better. The highlight clearly is the return on equity. The asset quality seems to be improving as well. The cash earnings just above, perhaps the dividend just a little bit under there.
Just on, I guess, how the Aussie share market then fares, because obviously we've been watching the moves back into the banks. What do you think we'll see? We saw that lift on global equities thanks to the Bank of Japan stimulus. What do you think we'll see today? Because the SPY's pretty flat, isn't it?
SPY's pretty flat. I mean, we need to remember as well, we've got to look at where US futures were. I mean, they really went along for the ride on Friday afternoon when the Bank of Japan effectively went all in. I mean, they were just absolutely monster moves that we saw across all assets, but largely the US futures had reacted. That obviously therefore suggests that the moves that we saw in the S&P over Friday night, where we saw the S&P close at an all-time closing high, have been largely priced in. In fact, the S&P futures are up about 0.4% from our close. So that suggests to me we are going to see a very modestly higher open. It looks like we're going to see a continuation of what's worked. Names like Qantas, names like CSL, Cochlear, Certex Medical, all these ones that are doing that are seeing really good strength at the moment should see some continued support on dips. The banks, again, as I say, look okay. This result from Westpac, just looking at the headline numbers, I see no reason why we're going to see a major sell-off on that. Just as I say from the headline numbers. In fact, it looks like the banks could see some support with material names looking a bit under pressure. BHP's ADR, for example, is suggestive of a slightly lower open, and that's really the trade. The trade has been, do we want to be overweight growth? Do we want to be overweight cyclicals? At a time when the trade that has been working exceptionally well is anything with bond-like qualities. And for me, given what we're seeing in the macro backdrop, if you think top-down, if you think that the Bank of Japan have just stepped it up a notch, the ECB could come out this week. They won't talk about quantitative easing, but they will certainly lower the barriers to the targeted long-term refinancing operation, potentially hint that they could do more on the QE side of things. If you look at what's happening from the Riksbank, other central banks, they've lowered volatility. That's still very good for income structures. So the banks, from a trading perspective and investment perspective for now, look quite nicely supported here. So
I guess just coming back to Japan, what do you see? It was a surprise move there, the stimulus to be ramped up. What does this do? Does it just, provide support for continued rally in equity markets?
Well, it gives a continued rally in the topics. It gives a continued rally in the Nikkei. I mean, what they did on Friday was it was breathtaking, to be honest. I mean, they came out at a time when most of Asia was either having lunch or was ramping down for the afternoon, talking to clients about different positions, how to play next week. And they just came out and surprised people. Most people were expecting further action from the Bank of Japan, but they weren't expecting it until January. So they've really surprised the market. And the Bank of Japan Japan have a massive history of doing this. They know market expectations. They hit people when we're not expecting it. Plus, they had the added benefit of coming in just before the UK and US Open as well. And that's what we saw. Nikkei futures, dollar yen, continue to rally throughout European and US trade. The Nikkei is closed today. The futures market is open, but if the Nikkei was to open today, we'd see another 4 or 5% higher from where that market closed on Friday. You know, what we saw from the government pension investment fund to reweight their domestic allocation towards equities towards a sort of 25% midpoint range, that's been largely speculated. We've been talking about that for a couple of weeks now. It's been in the Nikkei newspaper, but again, the timing was slightly awry. We were expecting that towards the back end of the month, if not early December. And if you look at what the actual government pension fund has detailed to market, it looks like they're going to be, overall, in terms of their reallocation, will be buying foreign assets, and they'll be doing that completely unhedged by all accounts. It means an outflow of around about 120 billion US dollars. That keeps the yen weak. And it keeps domestic equities. You know, we've got to be looking at names like Mazda. We've got to be looking at names like Honda, Sony, who have reported last week good quality numbers. You know, if you're looking at investment now, Japan seems to be one of the great destinations to be looking at.
It is a huge week. Again, first week of the month always is for markets. What's the big event for you? Is it non-farm payrolls?
Payrolls is always interesting, of course. I mean, but it's not the end of the thing. I mean, ultimately, we know jobs are improving, and it's about inflation. So, I think if you're going to look at those numbers, have a look at the U6 underemployment number in the US. Have a look at the average hourly earnings. I mean, that hasn't really deviated from this sort of 2.1% annualised growth rate. If we do see a number above 2.5%, heaven forbid, then you will see the dollar continue to rally. But the trade at the moment, which we're looking for, is there going to be a continued rally in the US dollar? Is there going to be a continued sell-off in the US Treasury market? Is there going to be a continued sell-off in the gold price? Because there is really no reason to be holding gold at the moment. And I think those situations continue. Are we going to see equities bid up? What's going to be said from the ECB meeting? Domestically, of course, we've got the RBA tomorrow. We've got trade balance numbers. We've got the employment numbers, which I suppose get less focus these days. And of course, I think the big one is going to really be what happens from the statement of monetary policy towards the back end of the week. Because Glenn Stevens himself has said it's not just about the statement you get from the RBA meetings. It's about the outlook that's generated from the statement of monetary policy. And if you recall what we saw in the last one back in August, there was a massive deterioration in their outlook for inflation for next year. Even so much that the headline number could be below the bottom of their range. That opens the prospect, I suppose, that the RBA could come out and join what we've been seeing from the global monetary easing side of things and potentially sort of throw its weight behind this further rate cuts further down the line if they need to take part in the easing cycle here.
Chris, always appreciate your analysis. Thanks so much for joining us this morning.
Thank you, Bridie.
Chris Weston.